Welcome to our educational video on key concepts in value investing and portfolio management from the book Modern Value Investing, 25 Tools to Invest with a Margin of Safety in Today's Financial Environment. As the name of the book hints at, it gives us 25 tools to invest in today's financial environment. If you're a beginner or an experienced investor, the book provides you with valuable insights to enhance your investment decision-making. So let's dive in. The first part of the book talks about the benefits of value investing and emphasizes the following. A focus on risk. A value investor's primary concern should be minimizing the risk of permanent capital loss. By prioritizing risk management over expected returns, value investors can identify investments with low or no risks that offer positive returns. And as Warren Buffett once said, the first rule of an investment is don't lose money. And the second rule of an investment is don't forget the first rule. And that's all the rules there are. Margin of safety. Investing with a margin of safety, which involves buying stocks at a significant discount to their intrinsic value, is crucial for value investors. It provides a buffer against potential errors in analysis and helps mitigate against the loss of capital. Mindset and emotional stability. Value investing requires emotional stability and a long-term perspective. Value investors differentiate between intrinsic value and market-created illusions, remaining patient and avoiding greed and fear-driven decisions, and as such take advantage of the irrational market behavior. The next part of the book goes through valuation and the 25 tools that we can use. It's good to keep in mind that valuations can't be precise. There will always be a market inefficiency. Despite the belief that the market is efficient, historical evidence suggests that the market often values businesses irrationally. It can overvalue or undervalue companies, and this presents opportunities for us to buy or sell companies. The importance of proper valuation. By having the ability to accurately value a business provides us with a significant advantage in investing. By understanding the true value of a company, investors can capitalize on market mispricing and make informed investment decisions. As such, we can exploit market mispricing. It allows us to disregard the market's opinion and take advantage of mispriced stocks. By identifying undervalued or overvalued companies, investors can then buy low and sell high, maximizing their returns. To be fair, we all know these things, but how do we actually find it? So there are some tools in today's digital age. I'll start to go through the 25 tools, as the book promised, for value investing, and an emphasis on fundamental analysis. The first tool, use a range of values. Buy when the current price is below the most pessimistic intrinsic value estimation. Use a range of intrinsic values for a company and compare them to the current stock price. And buy only when the stock price is below the most conservative estimate, and as such, providing a margin of safety. Tool number 2, net present value calculation. Calculate the discounted value of future cash flows or earnings to assess the attractiveness of an investment. Tool number 3, liquidation value. Estimate the net value of tangible assets minus liabilities to assess the value of a business if it were to cease operations. Tool number 4, look at the stock market price. Use the stock market values to evaluate the intrinsic value of a company in specific cases. Compare the valuation of a company's unit to similar businesses traded in the stock market, or evaluate the valuation of an investment company. This tool is useful for relative valuation when direct comparisons can be made. Tool number 5, the value for a private owner. Assess the potential value of a company in a private takeover scenario. Analyze the company's financial, operation, and growth prospects, as if you were the private owner looking to acquire the business. Consider also the synergies and potential value creation in a private ownership context. Tool number 6, measuring the intrinsic value. Calculate the discounted value of cash that can be taken out of the business during its remaining life. Use past average earnings and adjust for growth and cyclicality to assess the intrinsic value. Tool number 7, return on invested capital. Evaluate how effectively a company utilizes its available capital. Tool number 8, growth as a key component. Recognize that growth and value are not mutually exclusive. and should not be artificially differentiated. Tool number 9, CAPE ratio. Utilize the CAPE ratio to assess the long-term value and eliminate short-term earnings volatility. Tool number 10, cash per share, net cash per share. Assess the margin of safety by comparing the company's stock price to its net cash per share. Tool number 11, dividend sustainability. Evaluate the sustainability of a company's dividend based on its cash position and cash flow. Tool number 12, determining a business moat. Assess the presence of a business moat by evaluating factors such as low cost advantage, switching cost, network effects, strong brand name, reputation, economies of scale, and government protection. Tool number 13, use what none of the great investors had before. Google. Utilize internet resources such as search engines or even ChatGPT to gather information about the management, past performance, and how they deliver on promises. Tool number 14, analyze the quality, integrity of the management. Evaluate the quality of the management team and their alignment with shareholders' interests. Tool number 15, potential activist involvement. Consider the potential involvement of activist investors as a margin of safety. Tool number 16, it all boils down to the price you pay. Consider the sector's conditions and valuation when determining the price to pay for a stock. Tool number 17, analyze the cyclicality of the sector. Acknowledge that volatility and cyclicality are inherent in investing. Tool number 18, analyze the impact of the natural cyclicality of an economy. Recognize that economies are cyclical and recessions occur periodically. Tool number 19, avoid value traps. Be cautious when investing in stocks solely based on their low price or perceived value. Tool number 20, avoid secular declines in a sector. Consider the long-term outlook and supply-demand forces affecting a sector. Tool number 21, look at insider activity. Monitor insider trading activities to gauge management and employee confidence. Tool number 22, check the sustainability of the dividends. Check the historical sustainability of the dividend payments as an indicator of value and potential catalysts. Tool number 23, determining the market sentiment. Evaluate the overall sentiment and market conditions to assess the stock's potential performance. Tool number 24, look at the quality of the assets on the balance sheet. Consider the quality and strengths of the company's assets when evaluating its value. Tool number 25, how and where to find bargain investments. To find bargain investments, value investors can explore areas such as corporate liquidations, complex securities, risk arbitrage, spin-offs, emerging and frontier markets. These tools should allow us to evaluate an investment and evaluate the current investments that we have. So we can purchase more when something drops below what we believe is a fair price, or when something gets too expensive so that we can sell. However, sometimes we should sell in other scenarios as well. This can be when there's been a fundamental change in the company. We should also avoid overexcitement and maintain our discipline. Excitement should not drive the selling decision in value investing. It's crucial to remain disciplined and not hold on to a stock past the right moment. Consider also changed circumstances. So if the circumstances surrounding a stock has changed, such as the launch of a new product that doesn't meet expectations, it may be appropriate to sell and cut your losses. Another very good reason to sell, it's for portfolio rebalancing. So selling and buying stocks for portfolio rebalancing is important, especially if some of your holdings has increased over the desired asset allocation and increased the risk of your portfolio immensely. And the final one is if you find something better. However, constantly trading stocks and looking for the newest, shiniest thing isn't the best thing to do. It can lead to high transaction costs. So I suggest you're very disciplined with this. The book also goes through another very important thing about falling knives. It goes through 10 rules for catching falling knives. I think this is especially important seeing as we're looking for companies that their value has decreased on the stock market. So the first rule is to determine if it's a temporal structural weakness. So assess whether the weakness in the sector is temporary or a long-term structural issue before attempting to catch a falling knife. Beware of your own psychological biases. Don't anchor to previous price levels or overconfidence in your personal insights. Acknowledge the unpredictability of the market. Differentiate the short-term oversold and the long-term trends. Differentiate between the short-term oversold conditions and the long-term trends to better assess the investment opportunity. Become an expert in the field or the stock. Gain an in-depth knowledge and expertise in the particular industry or stock you're considering to make an informed decision. Manage risk. Carefully manage risk and consider using options to lower the risk and potentially increase your returns. Assume the negative trend will continue. Diversify. Stick to the strategy. Avoid selling too soon by sticking to the investment strategy. Don't be swayed by the short-term price increase and maintain a long-term perspective. Learn how to say no. Understand the value of saying no to certain investment opportunities. While you may miss out on some returns, it can help prevent significant losses and enhance overall portfolio performance. So my key takeaways from the book are: in value investing, we know that we're supposed to buy undervalued stocks based on their intrinsic value, and with an emphasis on long-term investing and fundamental analysis. And in order to do this effectively, we need to set up a systemic approach and conducting a thorough analysis and managing the risk. This can be difficult, so I appreciate that the author has set us 25 tools to run through when we're evaluating an investment. I think one of the most difficult parts is the discipline and the psychology. Successful investing requires discipline and managing psychological biases, avoiding emotional decision-making and sticking to a well-thought-out investment strategy. This can mean to missing out on short-term hype in order for long-term gains. So understanding these concepts and applying them to your investment approach can help you make more informed decisions and minimize your risk and optimize your portfolio returns. Remember, successful investing requires a continuous learning and adaptability to changing market conditions. So stay curious and keep refining your investment strategies, but have a framework in mind. So thank you for listening, and I hope you learned something today.